Hello and good morning, listeners. This is Almus Market Mornings with Shikhar Garg, bringing in all the global financial updates just for you. Now, folks, there is a nervous dollar rally which can be observed taking place. The FOMC minutes released yesterday indicates there are members who can still favor rising rates, although all of them agreed for maintaining the status quo for the current session. Now, the consistent restrictive stance against the tighter liquidity and also credit conditions keep the concerns of the impending recession and also the yield curve inversions says so. So, and if we have to talk about the other indicators, the PMI numbers across the globe seems to be softening with India, Euro, US, and all the many more nations releasing softer numbers. So, JK, there's quite an interesting strength in USD that is being observed. What's your take on this?
Good morning, Shikhar. Actually, let's start looking at the USD against INR. It was quite a turnaround for the rupee from the first day of this quarter or the month rather. It started very upbeat on the first day. It's large flows and then RBI moving away for some time. But since then, uh, once the PSU banks have started buying and the rupee moved above 82, uh, every importer seems to have been brought in and is been hedging, and added to that we are also hearing, rather we were hearing yesterday about government debt repayments being covered through PSU bank. So we have a very sharp 0.7% rise in the USD against INR, which a week back people would have not even dreamt about, because flows were talked about, and bids were hard to find. And so at 70 to 80 to 40, we are really knocking on a very strong resistance, and that may take some effort to break, at least until the non-farm payrolls are out on Friday. But if the PSU banks continue to buy even at the higher levels, then we might see it break, or the other trigger could be global dollar movement up, because we are seeing rise in the dollar yields even with softer data. And like you said, in the FOMC minutes, the members were in favor of more rate hikes, although for June they were okay to keep it on a hold. But I think one of the important points that they were making, among other things, was the expectation that the market rates might inch up as the Treasury comes in to issue more papers, and may put some stress on the rate. So that is what is getting reflected, and this is something that we were expecting even as the debt deal was getting signed, because the Treasury general account balances had been completely used up, and then they have to fund themselves apart from issuances of their normal borrowing operations. So that's why we are seeing the yields going up. Yesterday we had seen even the longer tenor yields going up, in fact more than the 2-year yields, and that's the reason why the yield curve was slightly flattened compared to 110 BPs earlier. Now it is at about 100 BPs. In fact, if you look at the no, central banks, what they have been saying, hawkish statements despite economies showing weakness. And at what point will the central banks prefer to manage the growth versus the inflation? That looks very far. And if they go on hiking, eventually some cracks will appear in the some large cracks should appear in the economy before they think or rethink on the hawkishness. And also the yield curve inversion, which has been around for a while, hasn't shown up into a recession in the US, but that's not lying. And the long-term prospect for growth in the current financial conditions are not so great. So that will eventually show up. And all the current rally in the equities and the stableness in the dollar, all this looks somewhat vulnerable going forward. There was more data from US showing moderation in manufacturing activity. Factory orders rising by just 0.3% versus 8.8% expected, We already had ISM manufacturing PMI on Monday that fell more into the contraction territory. We'll have ISM non-manufacturing PMI today. As services has been holding up so far, I think we'll be keen to see whether that is still holding up, because any slippage in that will mean economy is further weakening. Also on the radar, we will have a stream of employment indicators starting today: ADP private payrolls, weekly jobless claims, job openings in the JOLTS data, challenge job cuts, and finally the non-farm payroll and unemployment rate tomorrow. These numbers, along with the PCE core inflation numbers, will be closely watched by Fed to determine their policy. And in keeping with the recent trend, Eurozone composite PMI again dropped below 50 for the first time since December. And the year-on-year PPI inflation was in negative territory. So Eurozone's underperformance is starkly visible, and their rates are still going up because of the inflation not relenting on the core. So once again, in Eurozone also, we're just seeing when things will break down, because very low growth, and in fact Germany being in recession and high rates are not something that will go together. Overall, we should expect the markets to somewhat be nervous ahead of the release of key numbers in the coming sessions, and expect dollar to be somewhat slightly beat. Key number on the dollar index is 103.50. A breakup that, according to me, can open the way for another 1 to 1.5% move up. And for the euro, it is closing below 1.0850 that matters. And if it does, and a move to 1.07 is quite possible. Looking forward to a very active sessions in the next 2 days. Thank you.
Okay, JK, that was quite good. And yes, folks, we have already observed the sharp rise for USD INR in the last couple of days. And like JK mentioned, it's the PSU bank buying or any further global triggers which are to be observed to further identify whether we can move past the 80 to 40 strong resistance, as JK mentioned. On the other side, we have observed longer tenor yields rising slightly, which has also further slightly flattened the inversion. And the long-term growth expectations, if we talk about with the current set of scenarios being observed, the manufacturing softening and the tighter liquidity and credit conditions, the expectations continue to be on the vulnerable side for the economy. But it is the stream of employment numbers along with the PCE core inflation which the financial markets are keenly watching, as these are the indicators which the FOMC have been keeping on their track for further FOMC actions. So the jobs number or the unemployment number should be released tomorrow for further cues on what can be the probable course of action for FOMC. On the European side, yes, the economy continues to see some sort of concerns on the growth side, with Germany technically in a recession and the performance continuing to be on the worrisome side. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.